Have you wondered if Bitcoin is actually a flight to safety? In other words, does Bitcoin maintain your wealth? And is Bitcoin better than any other type of financial instrument? Maybe that's gold, perhaps that's a treasury bill, perhaps that is cold hard cash, could be something else. Here's the deal. We're going to be looking at Bitcoin in a very, very specific way, and that is perhaps, yes, perhaps Bitcoin is indeed a flight to safety. Now, the way that we're going to do this is a little bit more unique than what anyone has explained to you before. This is a very, very rare training, and this is normally something that we would only share with our inner circle. And that's because we're going to go in depth, really, really deep, in fact, into the specifics of what you need to achieve in order to maintain your wealth. Now, if you're not interested in money, if you're not interested in investing, if you're not interested in maintaining your lifestyle and maintaining your wealth, then this probably is not the video for you. But if you are interested in sort of saving yourself and saving your retirement, saving your wealth in a really profound way, well, this is for you, because this is not just about Bitcoin. It is beyond that. Now, with that out of the way, my name is John S. Rhodes of the Rhodes Brothers. This is Greater Wealth Through Mastery, and thank you for being here. The Rhodes Brothers YouTube channel is all about things that help you improve your life, achieve greater wealth, greater relationships, better health, and so on. Go ahead and subscribe right now or hit the like button. Okay, so we need to start in sort of a weird place in order to really understand what's going on with Bitcoin and if it is indeed something that's going to help you maintain or even grow your wealth. We have to go back to the beginning, and that is risk-free rates. Now, I'm an old school Warren Buffett value investor type of guy. I very much like value stocks. I very much like dividends. So if you're here and you're here right now and you're zeroed and focused in, well, listen, that's my background. My brother Matt is a little bit more willing to take on risk than I am, but he's also a wee bit younger than me, so he can take on more risk. But as I get older and older, it becomes of greater and greater importance to maintain the wealth and grow the wealth that I have and do it in a relatively sort of conservative way, which makes it seem strange because many people say, most people in fact tend to think that Bitcoin is very, very risky. And that's because they equate risk with volatility. And risk is actually your friend, especially because when you have great volatility to the upside, it means prices are skyrocketing. Prices are going through the roof, as they say. Now, obviously, you have the bottom dropout once in a while, but over time, over 4+ years, if you can hold your Bitcoin for that amount of time, you can do extraordinarily well. And I believe that is the case even going into the future. When we go into the next 5, 10, 15, 20 years, I really do think that we're going to see more and more investors come into Bitcoin as a flight to safety. Yes, as a safe investment, as something that holds value. Now, there's a lot that's going on here, and this is going to take some time. Now, the very first thing here that we have to look at are risk-free rates. Now, this comes from Warren Buffett. And what Warren Buffett does is he looks out 5, 10, 20 years, and he determines what is the risk-free rate. And the way that he determines that is it is the lowest, safest interest rate. The lowest, safest interest rate on your wealth, on your income, on your cash, all of the above. And that is based on U.S. Treasury bonds. Again, this is Warren Buffett, and I very much buy into this, the idea of looking out in the longer term and also looking at U.S. Treasury bonds as an indicator of what is risk-free. Because you put your money in, you're going to get your money back, and while your money is in this case, in Treasury bonds, you're going to return, you're going to get a certain amount of money returned to you by way of interest. It is U.S. government debt that you're buying into, and the U.S. government thus far has reliably paid back debt. So that's a really good thing. You put in, $10,000, you're going to get your 10,000 back, and you're also going to get some interest. So this is the lowest risk of default to you, and that's what makes it risk free. All right, so this is seen as no risk, or very, very low risk, as low risk as you can possibly get, and really still be an investment. I would say that that's even better than just holding cash under your mattress, because if you hold cash, you and I both know that the value of that cash goes down because of inflation. More on that in just a moment. And the reason that this matters, again, we're talking about Bitcoin as a flight to safety. So we need to start with what is the lowest possible risk. It's very likely not Bitcoin for a whole variety of reasons, but it's not because of the volatility. Remember, it's not the price going up and down, because if the price is down here, but the price is increasing over time, even with those big drops, if you're going up dramatically over 4 and 5+ year time frames, if you're a long-term holder, this is a wonderful thing. So upside volatility can greatly outweigh downside volatility. That doesn't mean it's super conservative or that you don't have to have a strong stomach for the ups and downs, but it is very, very telling. So back to the risk-free rates, 10-year treasury bonds. Again, we're doing this because we need a foundation. We need a way to compare. All comparison is in comparison to something. It's always relative. Therefore, we're going to use the 10-year U.S. Treasury bond as the comparison to all other riskier investments. And I think this is important, I define risk as the risk of permanent capital impairment. And what that means is you put money in and you don't get that money back. You put value in and you don't get that money back. You don't get the value back out of it. Therefore, we have the baseline with the 10-year U.S. Treasury bond, and now we have something of a hurdle rate. The hurdle rate is if you can't get over whatever the 10-year U.S. Treasury bond is paying, why would you invest in that particular investment, that security, whatever it might be? It doesn't make any sense if you're going to get like 2% for the investment when you could get 3.5 or 4%, let's say, with a 10-year U.S. Treasury. Why would you do that? It doesn't make any logical sense. And so the savvy investor says, well, it's the lowest risk and the highest yield I can get. Now, you might play off of those things. You might say, well, I can get a higher yield, but it might be a little bit more risky. And so then you can play around with that. You can look at shorter duration. You can look at longer duration. You can look at higher interest rates, higher yield. You can look at higher, let's say, dividends, for example, higher growth rates. But what matters is you have a foundation. You've got the 10-year bond, right, the treasury bond, as a way of saying, I need at least this much, otherwise I'm not going to bother. So let's define the hurdle rate, just to be super clear here. The minimum return for taking risk. Again, risk-free is the 10-year U.S. Treasury bond. So the hurdle rate is the minimum return for taking risk that is needed to justify taking the risk, right? So you know that there's risk in other investments. Well, it could be a lot of risk, but are you overly compensated for it? So if there's like, a little bit more risk, but you can make twice as much money, that can end up being a very good investment for you. Higher risk requires a higher hurdle rate. And you can use this to decide if your investment is worth it, or the potential investment is worth it. If the return beats the hurdle rate, the investment can be good. Now, we always have to be looking at that foundation, at the minimum hurdle, right? Which is, again, the U.S. Treasury bond, the 10-year is a good one to look at. If you can't make a lot more over that for the added risk that you will be taking, right? So if you are lending money to a company, how reliable is the company? Are they going to pay you back? Have they, what's their bond rating? And that's just looking at their bonds. So you have to look at what the risk is that you'll get your capital back, so that you have return of capital and then return on capital. And rewind that if you need to hear that again, because it's so critical. One is, do you get your money back, yes or no? How reliably? And then second of all, how much more are you going to get back from what you put in? So are you going to get back your original investment, and then how much more are you going to get back in addition to that? So that tells us an awful lot about the investment. Okay, so again, we have the baseline, and now we're going to look at what super investors typically look at. So what super investors typically look at is a much, much higher rate, relatively speaking, compared to the 10-year U.S. Treasury bond. By the way, yes, we're going to come back to Bitcoin in a moment. I'm just making sure that you understand the baseline and that you also understand the idea of the hurdle rate, and then what it is you need to be getting paid to actually invest in something that will pay you a lot more. Again, there's always risk if you're not investing in the 10-year U.S. Treasury bond, at least at this point in time. Okay, so Warren Buffett, his hurdle rate is around 10 to 15%. Howard Marks, his hurdle rate depends on the market risk, but I've heard anywhere from 8 to 15%. And then Charlie Munger, who was Warren Buffett's right-hand man at Berkshire Hathaway, he was looking always for a 10% or greater return. Now, what that tells us, and these are some super investors, they tend to be more sort of value oriented, right? So they look for things like a margin of safety. That means if things squiggle around that you're not going to lose too much, you're going to lose very little, in fact. And you want to make sure that the numbers are realistic. Like if you requested 50% or 100% return, that probably means it comes with a tremendous amount of risk, and it doesn't really make a lot of sense. However, 10 to 15% is fantastic. And if you can do better than that, obviously things are good. But you're trying to do this measurement of the risk-free rate with what is possible. Now, that being said, we know that Bitcoin has done much, much better than 10 to 15%. So we're going to come back to that in a minute. But what I do want to say right here at this point is that Bitcoin, as long as you can hold it for more than 4.5 years, 5 years, if you can hold it that long and you're a long-term investor, you're going to beat the U.S. Treasury bonds, and you're also going to beat the hurdle rate as established by Warren Buffett, Charlie Munger, and Howard Marks, for example. You're going to beat them. It's going to do better than that. So in that case, just making enough for the risk makes an awful lot of sense. But you do need to be willing to hold for greater than a few months. Otherwise, you end up being a speculator. You end up being, someone who is a trader, not an investor. And therein lies the difference. You're looking for a long-term return of and return on your capital. And we know that Bitcoin has done much, much better than that. Now, before I get to Bitcoin as being a possible flight to safety, keep this in mind as well. We know that in these days that we're in right now, that inflation is running hot. Some would say that it's running, back kind of to normal, what it was in the old days. Certainly, if you look back in the 1980s, it's pretty crazy what the inflation rate was. And beating inflation alone was very, very difficult, if not impossible to do. But that's why we do have to look at inflation. The way that I think about this is the way that a lot of people like Lynn Alden thinks about this, and I think Luke Gromen and Preston Pish, these folks are in the Bitcoin ecosystem, so to speak. And again, that was Lynn Alden, Luke Gromen, and Preston Pish, just 3 examples right there. But they tend to look at the global, not just the US, the global M2 money supply. Some people call this liquidity, right? So they think of the amount of cash in the system overall as being liquidity, and that's roughly equivalent to the M2 money supply. So the M2 money supply is basically all the cash and cash-related instruments in the world. I don't have the exact number right now, but what I can tell you is that when you look at the global M2 money supply and how it's been going up over time, it's the average annual rate of M2 money supply growth, that is money printing. That's not quite right, but it's a good way to think about it. Think about that's okay. Let's just say that it is money printing. It's not, but it's a great way to think about it. It's about 7.5%. I've seen everything from about 5 or 6% up to about 8%, but the number that comes in the most is between 7 and 7.5%. Again, global M2 money supply. That's the amount of money that's printed every single year. That's the cash. The money is better, not cash. The money, the money supply and its growth in the entire world. What that tells you is that if you are not getting over 7.5%, then you're not beating true inflation, which is money supply, not CPI like the government tells you, but actual amount of money, because the world is made up of fixed goods and services, right? You do have depreciation as it relates to technology and also outsourcing, offshoring, and there's lots of other ways to have some depreciation. But in general, the world is kind of bolted down and physical. So products and services in the real world, and there's more and more and more money chasing a limited number of goods. And that's why the price of everything keeps going up and up and up, because there's more money in circulation, and the demand for goods, especially high quality goods like, let's just say, grass fed, natural, organic beef, or healthcare, or education. The price of these things keeps going up and up and up because there's more and more money chasing those scarce goods. Scarcity, you notice. Whereas things like potato chips and electronics, the price has roughly stayed the same or even gone down. And in large part, it's because those things are easy to clone and replicate. It's easy to drive the cost down on, Franken food, and it's easy to lower the cost of electronics because of mass production, robotics, and so on, and just sort of technological innovation. But what's critical here, we have to sort of rewind a little bit. What's critical here is the 7.5% increase in money in general. That means that if you have money that's under the mattress, it's getting burned up. Even if you have money in the bank and it's earning a couple of percent, you're still 4 and 5% behind. Now, I hope you remember the number from earlier that I threw around. I just sort of threw it out there. Let's say the 10-year U.S. Treasury bond rate is like 3.5, 4%. Let's say it's 4.5. Let's say it's even 5%. It's not, I don't think, not at this point in time. But let's just say the 10-year is trading at 5%. That's still less than the 7 to 7.5% increase in money supply. That means you are losing out purchasing power. Your wealth is being eroded. Now, these are complex topics, and I'm trying to say them over and over in different ways. I'm trying to attack this from many different angles so that it makes sense that Bitcoin is perhaps a flight to safety and that it does hold your value over time. Kind of critical there. But that is the interesting note here, is that if the money printer, right, the world's money printer, not just the US, but the entire world's liquidity, the amount of money in the entire world, if that keeps going up and up and up and up and up, you know what's happening, right? That means that the price of everything goes up, and that means your investments, unless they're over 7.5%, they're barely holding their own, or the actual value is going down. Even if it feels like they're going up, they're actually not. And that's where, nominal versus actual comes in, right? Because if it's nominal, it's like, oh, the value of my house went from, 300,000 to 500,000. Whoa, I'm getting rich. But the reality is that you're not getting rich because everyone else's house has gone up by that amount because of the money that's been printed into existence. And so you feel richer, but it's a nominal wealth increase. It is not an actual wealth increase. Again, it takes time to wrap your mind around this, and it's very challenging. But the reality is, and the truth is that your house probably isn't actually worth more. Even with the cash flows, if you're renting it out and so on, it's not as though you are getting, wildly richer. You didn't go from 300 to 500. You didn't gain $200,000 of wealth. If you had a house that was 300 and went to 500 and sold out and you made 200,000 on that, it's likely that if you wanted to turn around and buy a house that was 300,000 now, it'd be next to impossible to find an equivalent house. In fact, I would tell you that finding even a house that's equivalent at 500,000 might be difficult. You might need to spend 550 or 600,000 to get an equivalent house, so it's even more than the 500 that you have now. Again, if you need to rewind that and hear the numbers, it's important, but you might not even be keeping up with inflation having a house that increases in value 50, 100, multiple hundreds of thousands of dollars. It's really wild and really crazy. You have to start peeling away the layers to really understand what it is that's happening with your hard-earned money and the wealth that you've been trying to save over time. And this is also an explanation of why you feel like you've been held back. That's because the money printer is indeed holding you back. More dollars means lower wealth per unit, right? So every dollar is worth less. So you need more dollars to even break even. That is almost the definition of inflation. Or I'm coming at it sort of from a different angle, but it is inflation. All right, so how about Bitcoin? What's it looking like over the next 10 to 20 years? Now, if you ask Michael Saylor, by the way, on the Rhodes Brothers channel, there's quite a few videos at this point in time about Michael Saylor and Bitcoin. So you can sort of dive into Michael Saylor for yourself. But let's just say Michael Saylor knows a thing or two about Bitcoin. And one of the things that he has done is he's laid out the case for Bitcoin over the next 20 years or so. And his bear case, his conservative estimate, is about a 21% annual growth rate. His base case, right, kind of just base case, is 29% annual growth. And his bull case, optimistic, right, is 37% annual growth. Now, here's the thing. Even if he's wrong, the dealio is we could still very well be looking at 10, 12, 15% annualized growth over that time period. Now, is there going to be volatility? Yes, but is volatility actually equivalent to risk? No, it's not a one-to-one equivalence, not if you hold for a long enough period. And again, volatility is your friend when it's on the upside, because that means you have these wild, God green candles, right? That means the price goes just crazy. The price goes wild. And even when the price drops, it's not dropping as much as the crazy up, right? So that's the deal. Again, volatility can be your friend because you can buy down here and sell up here, or buy down here and just hold, buy down here, hold, buy down here and hold, and so on. I know you understand that. You're a sharp cookie. So what this tells us is that when you look at the 10-year U.S. Treasury yield, and let's say, again, it's like 3, 4%, 5, 6%, that's not even telling you the whole story, because you have M2 money supply inflation. That means it's not really risk-free. It's not really safe, because the M2 money supply, if that's what inflation really is, it's eroding your wealth day in, day out. So you need to get well over 7.5%, and it needs to be over a long enough time period to sort of equalize and play out the annualized rate of return. There are very, very few reliable investments that are actually holding and storing value. I would say that Bitcoin is one of them. If we can trust the sort of the forward thinking of Michael Saylor, we're looking at really, 20 to 30%, let's say, over the next 10 to 20 years. There's nothing else like it. This is not financial advice. This is not an endorsement. This is not, hey, go buy a Bitcoin right now. But this does tell you and does explain how Bitcoin can be a flight to safety. Again, ignore volatility. Think about holding and storing value over a longer period of time, right? More than 5 years. And then think about what your time is worth and where you can sort of store your time, store your energy. Bitcoin stores your time and energy and value. And also we need to be thinking about some other little pieces and parts here. And so this is the wrap up. And I think this is critical when we bring it all together. Number one is that all of the wealth measurements that you conduct should be done in relation to something. So if I said, hey, earn 12%, that shouldn't mean anything in and of itself to you. Instead, it should be 12% in comparison to what other investments, 12% in relation to what risk, and 12% in relation to the opportunity cost of other investments, right? In relation to everything from inflation, in reference to gold, in reference to, so the relatability, the reference ability of an investment is of critical importance. Okay, so relativity is key. Time frame is also key. So I can't say anything about investments for weeks or months. In fact, I can't say a whole lot or predict into the future hardly at all, unless it's multiple years, if not a decade or more. I do know that in general, just keep buying does work. Buy and hold does work overall. I do know that dividends and dividend increases are wonderful. I do know that growth is awesome and growth is necessary for a company for the price to increase, and so on and so forth. I would even say with Bitcoin that you need more and more users using it. You need more and more people holding on to it. You need more and more use cases. So maybe you have like the baseline, and then you have layer two like Lightning. You have technology that's on top of Bitcoin as well. So there should be growth there as well over time. Bitcoin very much is a store of value. So whatever your value is, whatever value you've created, you need to store it somewhere. Whatever value that you've created that's in the excess, right, above and beyond, so you provide value to customers, for example, or your employer, or those kind of customers. In that case, you have money that comes in, you're trading time for money, the money comes in, and then you pay for your bills and other expenses and employees and who knows, whatever else, right? You pay for your life, and then whatever's left, you need to save some for the emergency fund. But the money that is above and beyond that, if you're not paying down debt, then, and even that, you might still pay down a little debt and still invest. But ultimately, you need to store that value, the excess, the profits, the excess amount of money. There is some for most people. It might not be much, but it could be also a tremendous amount. Depends on your situation. In that case, you want to store your value in the place that is, bedrock, foundational. It's not going away. That people trust, that there's a limited supply, that there is scarcity. And I think the scarcity part is of profound importance, because if there's no scarcity, then it's just like anything else, and people can replicate and clone, and then the value of it goes down. Just like fiat dollars, just like the money printer, you want something instead that does the exact opposite. And it's decentralized, so there's not a centralized authority that can just, print money. You can't print more Bitcoin. It's impossible to do that. That's one of the reasons why it stores value so well. And then also I would consider the debt loads that not only you might have, but that the country you live in could have a tremendous debt load. And that debt load puts your stored money at risk from inflation, hyperinflation. It puts your money at risk of being useful, in terms of a utility, being able to use those dollars to buy things. Now, that does not mean in any way that I think that the U.S. dollar is going away. I don't think that for a moment. I think we have a long, long runway of U.S. dollar dominance. But what I do think at the same time is that there are places that are better to store your money than, let's say, bonds that don't even beat inflation, or other investments that pay 5, 6, 7% that barely keep up with, or don't keep up with, the M2 money supply, right? The money being created. We have to do better as investors. We must do better than the M2 money supply. And it's kind of clear if you go back and watch this video if you need to, but I think it's pretty clear that if you're not beating the amount of money being printed, then the value of every investment cannot keep up. So you have to treat the M2 money supply as the hurdle rate, because if you don't, the value of what you have will go down, whether it's a bond, whether it's stocks. It could be almost anything that pays interest or gives you a yield. So the real hurdle rate is at least 7.5. Like the risk-free rate has to be, over 7.5, 8%. And it's like, well, there is nowhere, because it's crazy when you think about this. If the risk-free rate is below the inflation rate, that means you will perpetually be losing money, right? So if the 10-year US Treasury is, let's just keep it simple, 5%, and the M2 money supply is growing at 7%, that means you're losing 2% at a minimum every single year. And that's just untenable. So what that means is you need to get the 10 to 15% or better. I would say that Bitcoin is a possible flight to safety from the point of view of the returns look pretty good. The looking backwards, it's obscene, right? If you bought, 3, 4, 8, 10 years ago, you have been, very, very happy at this point in time if you held on. But we don't look backwards with investments. We must look forward. And when we look forward, the returns, the yield, if you want to think of it that way, that you can get on your value, not just storage, right? But the return, so the return of capital, but return on the capital, right? How do you multiply it and grow it? I do think that we're going to see what Michael Saylor says, 15, 20, 25, 30% annualized over a long period of time. Because what will happen is as any investment grows, as any asset grows, the returns you can make on it go down. It's a sort of a law of large numbers. That's just the way that it is. Okay, so this is John S. Rhodes of the Rhodes Brothers. Thanks for tuning into Greater Wealth Through Mastery. Look forward to seeing you in the next training. Leave a comment below if this resonates with you. Share it with someone if you would like to do that. It's from word of mouth referrals exactly like yours that the channel can grow, and that really truly does matter. Go ahead and subscribe to the Rhodes Brothers channel and like this video. We do appreciate you, and we'll see you in the next training. Thank you and take care.